Tom Aspray with the Viper Report Market Wrap video for the week ending April 24th. As we look to the week ahead with an FOMC meeting and a few other interesting developments, the question is whether the market pullback is already over or whether stocks will correct even further. The evidence is somewhat mixed, but I'll take you through it and share my conclusions. This chart of the NYSE Composite shows that it really wasn't a great week for it. It was a bit lower for the week, and you can see below here we have the McClellan oscillator, which is a classic example of what you see in multiple positive divergences at the market lows. We came down here, had a low in the McClellan oscillator, made a new low, or made a marginal new low here. Still, we're showing a pattern of higher lows in the McClellan oscillator, the break of the downtrend, and the strong move above the zero line, which we commented on at the time. For the week, the Nasdaq 100 led the way, up well over 2%, with 0.5% gain in the S&P and a third of a point gain in the Russell 2000, whereas the other averages were lower, led by the Dow Transportation, which had been a leader, and it was down 6.8%. So we did see some rotation out of certain sectors and into other sectors. Looking at that, the table that will be published tomorrow in the Viper ETF and the Hot Stocks report, you can see that some interesting developments. First of all, look at all the AD line numbers here are positive, so that's a good sign. We are still seeing some lagging. The Dow, DIA, has not made a new high. S&P, QQQs, and NYSE look quite strong. You can see that we pulled back a little bit. We were, I think, up close to 5% above the 20-day, now 3.3. Nasdaq 100, QQQs, most extended, up 5.6% above it. So they could have a 2 or 3% correction and still hold above the 20-day EMA, which is at 628.99. So you can see the NYSE has corrected the most, but all are still above their 20-week EMAs and well above their Stark bands. So, we talked about just not that long ago, we were down at the Stark minus bands, and that was a good sign that it was a high-risk sell, but a low-risk buy. Let's look at some of the individual indices. You can see this chart of the NYSE Composite, a daily chart. We focused on this trading range from, October to December before we got the expected upside breakout. Had a pretty good run, roughly from around 22,000 rather, up to well over 23,500. Last week we hit the R1 here. You can see up here at 23,220 with the R2, but just for April at 24,351. We pull down to the moving average here. You can see that the AD line, as I mentioned earlier, has made a new high for the NYSE All. So that means that the NYSE Composite should move above this high before there's a more meaningful correction. If you look down here below, you can see what else has changed. The bull bear, as I pointed out to clients last week, sharp increase of over 10 points in the bullish readings in the survey from the AAII, so that the differential has gone from below minus 10 to above minus or above 11.6. That's a very positive sign. That does favor higher prices in my view. Things like we get back up in the plus 20 area before we see a deeper correction. Down below here we have the NAAIM exposure index. First looked at this a few weeks ago when it was down in the 60% range. It's back to 94%. So those guys are getting back into the long side of the market. The weekly AD lines are positive. They turned down a little bit from last week's highs, but they all moved above the highs we made earlier in 2026. So the yearly R1, just the next meaningful upside target, is at 24,054. See, the 20-week EMA has turned up, and it's at 22,424, not all that far below the close. The S&P 500 closed up 0.8% on Friday, and you can see here that we expect the last time we looked at this chart, the put-call ratios were very low here, and they jumped up, to just below 1 before finishing downward here as the higher market probably caused some shifting of positions. Index put-call also had a brief bounce up to 1.2, now 0.95. No worrisome signs yet from the VIX or the VXN, both below their moving averages, trying to stabilize down here. So at any point here, you could see a rally back into that 2250, 25 area for the VIX and back up to 2750 or so in the VXN. But I think it'll take more than that to start a new uptrend. A new uptrend in both of these indicators, of course, would be a negative for the stock market. The 90% chart here shows that despite the higher close in the S&P on Friday, there were 30% of the stocks in the S&P were lower for the day. Obviously, you would like to see a much stronger number to say that that was a kickoff for this coming week's trading. S&P 1500 also not strong, and the Nasdaq 100 was plus 10%. Looking at the daily chart of the SPY, you can see we're closed just above the R2 here for April, and the support starts around 690. That's the 20-day EMA. Then drops down to 680 in the 100-day, or 676 in pink. That's the 50-day. Down below, you can see the S&P AD line did make a marginal new high, so it's in sync with the higher high in prices. Stocks only also made a new high. So as we showed you just a few slides ago, the NYSE itself has not made a new high. So this suggests a positive tone for the more common stock market as we head into May. And of course, also NYSE all also made a new high. So I would not expect either of these to drop back, below their moving averages, but it wouldn't be that negative if they did. It'd just not be expected looking at similar corrections in the past. It was a good week for growth stocks. You can see our ratio of the IWF, that's the Russell 1000 growth, to the IWD. When this is rising, growth is leading. When it's falling, value is leading. That was the case in 22. It had been correcting pretty sharply, since late October, early November, and but this week closed back above its 20-week moving average. That becomes the primary question, is whether this was just a pullback in the uptrend that's been going on since 2007, or whether this is part of a top. I'm sort of favoring the top just simply because of the technicals, but still think the growth could rally back up here in this 223, 225 area in the next couple of weeks. You can see the MACDs, have flipped back to positive, both the histogram and the MA here, but no, strong signs of a bottom like we saw in early 23. We were very bullish on growth because of this development, and also we were a little skeptical here as we made the high last summer simply because the MACDs had formed lower highs. So we still have some value positions. We took some profits on on part of our bank position, but we are looking to keep until a major top is confirmed. We'll be in IWD or IWF, whichever looks stronger, or a similar growth equivalent. We've been relying a lot more on our yearly pivot signals, which have done quite well. You can see this chart of the XLK, shows that, in 25 we dropped below, closed below the yearly pivot here, and then, flipped back to positive in May of 25. It's been positive, i.e. long XLK, ever since. You can see that we did have a pullback here towards, with a low of 126, did not have a weekly close below the yearly pivot, and now are charging ahead. So mixed bag, positive relative performance. Is strongly outperforming the S&P. Volume pattern here is questionable. You look at, the volume leading up to the peak here in October, November, and then on the decline, you can see the volume really increased. Also, the decline this year, both in February and March, was heavier than the subsequent buy. So certainly would not be chasing XLK up here. I'll be sending out the ETF values. So this looks at all the ETFs I track, their last price, and how they relate to the yearly pivot. For example, SMH closed at 506.44, well above a yearly pivot at 301, so that's really a strong positive number. A majority of the ETFs are above their yearly pivots, so that's positive. If they have a close below it, that would be a negative sign. So, if we look at, some that are pretty close to dropping below their yearly pivot, those are the ones you want to watch, particularly if you're long. So in red here, we have all the ones that are still below, including XLV and UNG, SOC, plus a bunch of the short or inverse ETFs, SH, TZA, QID, SDOW, etc., and SPXS. So it closed at well below its yearly pivot. It would take quite a rally in that to flip it back to positive. Looking at the watch list for the week, you can see still positive. Over 80% are above the quarterly pivot. Growth is still lagging slightly behind value, though, given what that chart we looked at, the ratio, it suggests those numbers could flip next week. We are seeing some daily negative signals on both the banks and the regional banks, and XLC, XLF, etc. So we still have the positive energies and materials and industrials. So back up in here, growth, XLV has obviously been hit fairly hard, ITB also, and cloud is one of the main negatives there. So short long, still all red here, so that means you should be in the long ETFs, all green there. There were two new weekly ETF signals, UNG, natural gas, negative, TAN, positive. If we look down at the breakdown, see what changed in terms of the relative performance. After such a surge, energy is trying to turn up. You can see sort of a mixed bag. PSX is a daily positive, as is MPC, but PSX has negative below its quarterly pivot, negative weekly and 3-day. Oxy here is positive weekly and daily, so we're just looking for a 3-day flip there. As same sort of case with EOG and MPC, also Unlike a PSX, it has a positive daily and a positive weekly. Materials are still, trading range or top. So we'll be watching it, next week here to see if we can hold this low here. That keeps the overall trend positive, which is consistent with the monthly charts. Industrials, you can see 50%, so it's right on the line. Materials at 54. Chart looks a little worse here, because you got a clear, lower highs, lower lows here. So UNP, could look at some of the railroads because they screamed to the upside last week. Consumer discretionary still suggests it's bottoming. So if it moves higher next week, we'd show a bullish pattern there. So what are we looking? ASIO, auto parts, Amazon's green across the board. So is Starbucks. So is Nike and Tesla. Home Depot and Lowe's are both daily negative here and 3-day positive. So see how that switches in the week ahead. If we start to see some of this, for example, lower Home Depot flip back to positive daily, that would be a good sign. Consumer staples did finish okay last week, and but still the RS chart here does not look encouraging. Looks better than healthcare, which really got whacked. United Healthcare here was about the only one that has an hourly positive, and also positive across the board. Though one of our local hospitals in Pennsylvania is no longer accepting their insurance. We'll see how that plays out. Financials getting a little iffy there. So, BLK, flip to a 4-hour. We've got some warning signs in JPM, BAC, etc. only on a daily. So, as always the case, we start to see somebody shift in to a 3-day negative. That would be more of a concern. As long as they can just hold with just a DTS or start to move back the other way, that would be good. Technology, still gangbusters. CRM, Adobe, had a couple of wide looks into it, was through the roof with a daily buy, but he'll has some room to go here. Microsoft, Oracle, they're all looking pretty good. AMD, of course, Texas Instrument had a strong week too, and you can see the chart. Is exactly what you want to see. Communications still looks negative. Don't like this pattern here, and it looks like it may, if we're gonna, the growth area that looks to be most vulnerable right now is likely in that communications area. Utilities, they were utility averages were down slightly last week, and but you can see sort of a mixed bag. Some 4-hour here. AEP is the only one that looks uniformly positive. Well, in addition to NEE, but the rest only 16% are positive. So that's still in a negative trend. In contrast, the real estate XLRE as well as the VNQ are pretty positive, 91% positive, and you can see SPG is just flipped to daily, so you'd be looking at some of these to flip positive daily in the week ahead for a sign that this rally has still got further to go. RS pattern, neutral at best to slightly negative. So next week we wouldn't want to see a break below this low. For those of you who missed some of the past videos, they put them up in the Viper report. So you can see this is the, at the start of April. Didn't see anyone else looking for a bullish surprise in April. There are a lot of bears, and you can see what happened and showed the rotation. This performance graph I find very useful. And then of course we had bullish signals from the weekly AD line the following week, on the 12th, And of course, we've continued to break out above these highs this week hit. So take a look at these if you haven't seen them already. Share me some feedback, positive or negative. And if you have questions, I'm thinking about trying to fold those into some of the videos. So you have a question about a market or more likely a technique, please send them to tom@viperreport.com. FOMC, do not expect anything this week, and we have some inflation numbers coming up, so we'll be watching those, and of course, as always, what happens in the Gulf. One last chart I meant to include. This is a daily chart of the Qs. I hope it was obvious during the presentation that I don't think, I think the next major move is going to be up. This correction could maybe last late through the week, but probably by the time we get into May, I would expect higher prices. This action in the Qs, we had a major breakout here, major breakout in the AD lines, all this range here, and also the RS. What we've been looking for since really March was when it was going to start to lead, and that was the point it started to lead. So, hope you have a good week trading. Thank you.